Hello, this is the Stuyvesant Square Consultancy with our review of the first quarter 2018 change in GDP by major category. If you have not viewed us before, we use the gold bars to show the first quarter, or the last quarter actually, the quarter we're reporting on 2018 Q1. The prior quarter is in blue, and the quarter for the comparable period last year is in red. These are the four major categories of GDP: gross government consumption expenditures, net exports, gross domestic private investment, and personal consumption expenditures. As you can see, last quarter had a tremendous burst in personal consumption expenditures, PCE, because so many people were replacing getting their insurance payments from the twin hurricanes that hit in the second and third quarters, the flooding in Texas and in Florida, and people were replacing automobiles, clothing, consumer durables like refrigerators, ovens, dishwashers, washing machines, etc. So there was a tremendous burst in that. And since this is a relative computation, in other words, how much did we increase beyond this quarter, a lot of that stuff was bulked up into the fourth quarter of 2017, so that you're not going to have as big an increase in the first quarter of 2018. The big winner in this quarter here was gross domestic investment, which increased 120 basis points over the prior quarter, which itself was pretty strong. We're seeing a lot more investment, and we're seeing perhaps a recognition of the tax reform that occurred in 2018 or the end of 2017. People are investing more, they get more rapid write-offs, etc., etc. Net exports, not bad. Government consumption expenditures, again, not bad. Nothing really to write home about. I'm going to skip over the analysis of personal consumption expenditures. It was principally services. There was very little in the way of purchases of durable goods and what have you. As again, we think because of the hurricanes settlements that occurred, people replacing things in the fourth quarter instead of buying them in a normal rate as they would in the regular economy had the storms not occurred. So let's look at gross domestic private investment. This was, as I said, the big driver of the GDP. It's 120 basis points almost, and considerably better than last year and better than the last quarter. Most of this was housing starts, which was, we thought, pretty good. It's not the type of investment that we like to see, but we prefer factories and equipment, things like that, that increase productivity and maintain jobs. And the other part of it was this inventory buildup, which is kind of the complement of the decreased personal consumption expenditures we saw in the prior slide. Here in the prior quarter, you can see that this fixed investment number was higher, and you can also see that private inventories were reduced in the prior quarters. One of the things that has concerned us in GDP reporting for quite some time is the volatility in the 3-month 10-year yield curve. Most analysts use the 2-year 10-year curve. We prefer the 3-month because it is more reflective of Federal Reserve policy. The Fed affects short-term rates much more than it does the outer years. So, or longer yield securities. So, and also the Federal Reserve Bank of New York has done research showing that there's a higher probability of recession when this number shrinks below 120 basis points. And as you can see, this is the 10-year 3-month yield curve here in gold. This is the difference between what the 10-year yields and what the 3-month yields. And as you can see, this number has been below the 120 basis point figure for quite some time. It has, at the beginning of the year, the start of the first quarter, it was quite low. It rallied here. As you can see, the two curves spread. The 10-year was up here, and the 3-month was here, and then it shrunk down again toward the middle of the end of the first quarter. Going into the second quarter, this number shrunk below 100 basis points. It went down to 96 basis points, as I recollect. That was on April 2nd. So it's continues to be short of where it should be. It seems to be recovering, but it's on a downward trend again. So keep an eye out on that. That's probably one of the things that you want to consider most in your investing in portfolio. We do a analysis in quite some depth at a website called seekingalpha.com, which requires sign up, but it's a free crowdsourced website of stock recommendations and economics, what have you. So check us out in more detail there. We go into excruciating detail, and we also show some of the things we suggest in the way of stock purchases or shorts based on what we're seeing in GDP. We first post our charts both on jobs and on GDP at our website, stysquare.com. Under client advisories, if you tip down there, you will see a flash reports, and you can access the charts there first. We post it on our Twitter feed, which is at stysquare here, and then we post it on our LinkedIn page here. So if you would like to keep abreast of our latest information, I suggest you use the Contact Us form that will drop down this subscribe to our mailing list page. It shows the email, first name, etc. That will give you access to our monthly newsletter, the free content, and if you wish, you can also add the premium content, which is available for a charge. That concludes our presentation for the first quarter 2018 GDP report. We will be back on Friday, May the 4th for the April jobs report. We look forward to seeing you then. Thank you for listening. Take care. Enjoy the rest of the week. Bye.